coming out of the weekend and into the open this morning, what you see on the screen is a lot of red, all right? So what's going on? Technology, down, all right? Financials, down. Consumer, down. Communications, down. Healthcare, down. I mean, if you want to get into the nitty-gritty of what's up today, energy's up today, utilities are up today, consumer defensive is up today. A lot of those risk-off stocks are starting to look very interesting to traders as people are getting out of the stuff that ran the markets up in 2024, and they're getting into things that surprisingly was actually things that moved higher during COVID. So go back 5 years and take a look at all of these stocks, and you're going to see the majority of them were moving in the same direction they are right now. The only difference is we don't have a COVID situation on our hands. We have, if you want to call it a COVID stock situation, that might be, but we're not in an all-out panic right now. So I want to take a look at the markets, and I want to talk simply about what's happened in the past. We'll do it this week versus last week and see if anything really has changed and where I see the markets moving in the future. Last week, we talked about the S&P 500 coming into the end of February, consolidating between 575 and 615. And so when I look at this chart again, and I saw this kind of like higher lows and higher highs, but I mentioned the higher highs were kind of stalling out. And this was the area that we saw as a potential threat for the markets to break out and move lower. Well, that's exactly what ended up happening. So take a look at this morning, and you can see here's that market that broke through below that 590 level. Now we're down around the 567.96. This was just after the market opened this morning. Now, what we're seeing here is we're seeing a new area of support that is starting to develop. And when we look at that support level, you go back and you look at before the election. And this is the theme that I'm starting to see in a lot of stocks, in a lot of commodities, even in cryptocurrency. We're seeing that theme where we were prior to the election, and we see these support and resistance areas around that 565 to 570 area in the S&P is starting to become a new support level. If this does not hold, we're back down into summer lows, which takes us down below the mid 500s. However, we've seen a considerable drop just since we got into February, because, not even a month ago, we were trading above 600. We were trading at all-time highs. What is the theme here? Right? What is the theme here? Uncertainty to Trump tariffs. Okay? When you see a market that's trading at almost 615 and drops down into the 560s, right? We're talking about about a 65 point drop, right? 65 point drop. I mean, that's that right there. Just from the you take 61 off of 610, that puts us down into around the 550 area, right? 555. We're close to that area right now. As you can see what's going on with the SPY, TLT. Now, going into February or coming into the end of February, we saw TLT, the bond market, pop. And I talked about a 3-point move that could happen with bonds where we could see a bit of a pullback and then a move higher. Interestingly enough, mortgage rates are as low as they've been here in over a month. So mortgage rates, 30 on the 30-year mortgage, have reversed course and have finally started to head lower. I think this is a longer-term good sign for folks that are out there looking to purchase a home. But right now, the reason why mortgage rates are moving lower, interest rates on mortgages are moving lower, is because there's a bit of a shock to the system right now. There's more inventory than normal sitting on the markets. That's causing home prices to move lower. It's causing people to pause their buying, and that's what's easing mortgage rates. TLT, which is the 20-year share Treasury bond ETF, higher, and we expect that 3-step process to come through. Here's what's happened since then. We got the move up to 92.50. We're getting the pullback. We got the pullback last week down to 90. Could this be that 1, 2, 3 that happens? And if it does, then it's suggesting the markets might not be done with pulling back yet. Because what we're seeing now is we're seeing the bond market moving opposite of the stock market. Typically, these guys in the last several years have moved together lockstep and barrel. They've derailed since then. Take a look at USO. Now, the USO, we talked about mid-February to mid-July, and that last 5 years have been bullish, and in the last 15, 20 years, this has been a near 80% pattern where we see mid-February to mid-July, that move on oil being something that moves higher. Now, you might say, but wait, Tom, Trump says drill, baby, drill. Isn't that going to be bearish for oil? Yes, it is. But we're talking about a 4-year term here, folks. All right. This is a 5-month cycle and a 4-year term. Could this 5-year cycle be bullish and yet still the 4-year term be bearish? The answer is yes. It could also be the opposite, okay, because nothing's 100%. But let's just take a look at what's happened recently. Now, recently, since Trump came into office, we've seen mid 80s on USO, all right, drop down to 70. Now we're starting to get a bit of a move higher, but maybe we don't have that bounce quite yet. Again, this is a 5-month pattern. It doesn't go up every day for 5 months. It simply means that 5 months from mid-February, 5 months forward, the price of oil and energy is higher. USO, since mid-February, is down. I want to say it's probably down about 5%. But take a look at a lot of the energy stocks out there, and you'll see them moving considerably higher. So it's the average of the bunch. Gold. All right, so at the end of February, does GLD have more room to run up? And we made a case for the fact that that is correct, that GLD should be moving higher. Well, what has happened in the last week is exactly what's happened. We're seeing oil get that bounce. It has bounced off the low 260s. It's currently trading at around 267.5. It is off a bit today because the overall markets are down, but is considerably higher than what we saw last week and closing in again on those all-time highs. So, putting this all together, are the markets getting overdone? It almost seems that way, right? You usually don't get this kind of a sell-off with at least some kind of relief rally, even if this is going to be a long-term negative going into this year. All of this uncertainty is due to the tariffs and not them being on, but the perception of on one day, off the next, pause it here, negotiate it there. It's the future perception is what got the markets in all of this uncertainty. Now, I believe the long-term volatility risk is going to be to the upside. And even if we get a pause, that when we get into spring, we get into late spring, typically late spring, summer into fall, we see volatility climbing anyway. That's typically a seasonal pattern. So it might take a few months to smooth all this out. Now, if you're an option trader, I want you to think about this. This is not the time to be buying call options unless you're finding certain stocks that have cheap implied volatility. The overall market, if you were going to just take some mud and throw it at the market, right, and just splatter it there, the average price of options on stocks is going to be higher than average. So as an option trader, on average, you're going to find that selling premium is going to make more sense. Or if you're going to be an option buyer, be a spreader. Spread the volatility risk out there. That's the thing to do.